Hey guys, welcome back to the Financial Interest channel. My name's Dan. So in this week's video, I'm going to cover investing basics and explain what a moat is, the different types of moats and how you can find them. So please stick around to the end and I'll also give you some tips on how you can spot that your company's moat is shrinking. So the first thing we need to go into is what is a moat. So you will be able to see that normally moat is thought of as the protective body of water around a castle. And the purpose of that is to obviously stop anyone from invading the castle. The wider and the deeper the moat is, the more difficult it is to invade the castle. And if the defense is so big, then there is actually a chance that you won't even bother to try, because you can see the defenses are so strong that you don't even attempt to cross the bridge or swim the moat. In business, a moat is an intrinsic, durable competitive advantage. Intrinsic means that this is so much a part of the company that you can't actually separate it. It's completely intertwined within the actual business. This protects the company from competitors who are trying to take market share away from them. So there are a number of different types of moats. The first one we're going to go into is a brand moat. A good example of companies with a brand moat would be people like Coca-Cola, Apple, Starbucks, Nike, Ferrari, these kind of brands that can really become a part of your life. The characteristics are that they can raise their prices every year and people will still buy it. Obviously, I don't think you need to go crazy. It needs to be still within reason. But these companies, Starbucks, Nike, Coca-Cola, Apple, you see it with the iPhone. They raise the price of the iPhone almost every year. The iPhone over the last 5 years has got more and more expensive, but people are still buying it. Maybe not as many as were a few years ago. So now they've kind of split the models into 3 or 4 different iPhone models, which cater to different prices. But still, that's something that almost every year, the price of the iPhone will go up. The next type of moat is a price moat. So in a price moat, we're normally looking at the low cost production. Any company that can bring the product in for the lowest price. So if your supply costs are the lowest out of all of your competitors, you can go down on price and offer the lowest price. Obviously your competitors can also cut price, but they might get to the point where they cut price so far down that they start losing money. So eventually they will go out of business. Good examples of price moats would be Walmart, Amazon, and Home Depot, because the effect of their network, now they're so big, is that their supply chains are large, so they can bring costs down really low compared to a lot of other smaller companies out there. The next moat we're going to go into is a secrets moat. Secrets moats are usually categorized by patents, so this could be pharmaceutical companies, or they could have the processes, manufacturing processes and things like that. That could all be secrets of the company. So examples of these kind of companies would be Coca-Cola, obviously with their recipe behind that. Also KFC with the Colonel secret recipe. You might also find these kind of moats in companies such as Apple for how they manufacture their products. Or you might find it in microchips, so Intel, AMD, microprocessors and that kind of thing. The point of this is that the processes they go through are either like very difficult to copy, or they're protected by law in the case of the patent as well. So the fourth moat we're going to go over is toll bridge. And toll bridge moats are essentially virtual monopolies. So you really don't have a choice to use them. This is typically associated with kind of semi-government entities as well. So utilities, probably wherever you live, in which state or country, you might not have the option of any other utilities. There might only be one utility provider, so you have no option other than to go with them. So you'll see like railroad companies, of course, there's already a railroad there. No one's going to be able to compete because they won't get given right of way to build a new railroad. And even if they could get right of way to build a new railroad, then it would cost so much that it would be prohibitive to actually do that. One example is PG&E, which is the utility company in California. Amtrak, Burlington Northern Railway. One company with a huge toll bridge moat is Google. They have an absolutely massive share of the search market. I checked in this and it's like about 86% of the world's search market is Google, followed by 6.4% is Bing. You know you've got a strong business when the name of the brand actually represents the industry itself, which is the case obviously with Google. And did you ever hear anyone say, just go Bing it? No, me neither. So there you can see a clear competitive advantage for Google. Another example of this would be, it's been photoshopped. And obviously Adobe's package is Photoshop, but Photoshop has now been used for the general term that the photo has been edited. So the fourth moat is a switching moat, and this comes about from basically the complexity in companies from switching from one provider or service to another. Some good examples of this are auditing companies. So if one business has always been audited by PwC, it's very difficult for them to switch to another auditor because they're so embedded within the company. Another example is IBM, who've been fairly slow to embrace new technology, but in banks and other places like that, they've had their back-end system embedded in the banks for so many years that the banks can't get rid of them because they would have to actually shut down the company to swap over to new hardware and everything like that. So they hardly have a choice but to stay with IBM. You'll see the same with Microsoft. It's very difficult to move over from all of their packages onto something else. And sometimes it will be to do with cost, and sometimes it will just be to do with the complexity of actually implementing that in a large company. And I'm sure you're going to see more of this, especially when everyone starts moving over to the cloud. So you'll see it with Amazon Web Services, Google Cloud Platform, or Microsoft Azure as well. A subsection of a switching moat is the network effect. So if a lot of your company or the clients or users are all using the same social media platform, let's say everyone is on Facebook or everyone is on LinkedIn, then there's really no point to move over to another platform with less users. So if all your friends are on Instagram, there's no point for you to move to another platform that has less of your friends on. So it's kind of keeping you within the network. So examples of this would be Google again, Twitter, Facebook, obviously Instagram, which is part of Facebook, and LinkedIn, which is part of Microsoft. All of these platforms have large networks, which makes it very difficult for people to move away. They don't need to move away, it's just not in their benefit to change to any other platform because the key is in the network. So now I'm going to go over a few things on how you spot a moat. So what you're looking for in the business is you're looking for consistent growth over time. So you need to be able to go and look at the numbers of the business, whether that's the sales, the profit or the earnings per share, the cash flow and the book value, and the debt as well. You want to look, and to be able to look over at least 10 years of data, you need 10 years really, because you want to try and see first a kind of long-term trend on each year. And also it helps because in the last 10 years, the company's probably seen some sort of an event or a recession, something which might have caused like a bit of a shake in the company. So you might see years where the numbers dropped a little bit, but then they recovered after. But what we're generally looking for is consistent improvement year on year. It doesn't need to be huge improvement, but it just needs to be consistently growing. And these companies are able to maintain and grow their profits over time. So we want to see the margins increasing even as the business scales up, or even more so actually as the business scales up. Another thing that we want to see is companies with multiple moats. You'll quite often see a lot of companies who have just one moat, but you'll find some really good companies who are kind of in maybe 3 or more of the moats. So I'll give you an example. Apple would be one of those companies. They have a brand moat, like they're a desirable product. They also have a secrets moat around how they build their processes, the software, the iOS. They, to a certain extent, have a switching moat as well, because once you've got a lot of their products on iCloud and you're involved in their ecosystem, you're not really going to go and then switch everything over to Android unless you're probably really unhappy. But that doesn't tend to happen a lot with Apple. And you could actually also argue kind of the same for Google. Obviously, it's a well-known brand. Google represents the word for the whole of the internet search industry. So it's got a brand moat there. Probably it could also have a price moat in the sense that it's probably the largest online or digital advertiser as well. I don't know if it is actually the lowest price to advertise with them because I'm not seeing from that side, but I'm pretty sure that because of their scale, they would definitely be able to be one of the lowest cost providers there just because of the sheer size. So they'll also have secrets around how they collect their data, how search works with their AI and everything like that. So that's how they fit into a secrets moat. They also have a switching moat because Google serves the needs of businesses and also people searching for things on the internet. And finally, it's also got a toll bridge moat because it's a virtual monopoly. You really don't have much other option than to use Google. So here we can go and take a look at Google Investor Relations. Actually, the parent company is called Alphabet, so that's what it will come up with when you search. So here we can see we've got the earnings for 2020. They've not released their annual report yet for this year. So we can go back to last year and go to the 10K, the PDF version. So this is how a 10K looks for Alphabet Inc. And now we can go down and just find the kind of table of contents. They give you business risk factors, which you should always read through. It's always good to read the whole of the 10K as well. So we'll jump down to some of the financial figures. And here we can see the revenues. So from 2015 to 2019, we can see that this is growing in price from 75 to 161. And these are in millions. So there we're talking obviously 75 billion. Then we can show the net income and also go down to the balance sheet data as well. So here we can see that the cash being held by the company is growing over time, as are their assets, which is always a good sign. And liabilities are growing, but nothing to be concerned at there, just because relative to the total assets, it's not increased. And here you can also see management discussion, which is always great to read through as well. So here we can go and take a look at Google's numbers. So this is something I took from Phil Town's Rule 1 toolbox. I'm actually subscribed to that, so this data is derived from there. I'll also put a link in the description for that. But here we can see the book value is showing growth over time. We've seen 2009 going into 2019, and then we've also got the trailing 12 months. Kind of the same story with earnings per share. This is seeing a growth. We do have one discrepancy in 2017, so probably that's something we'd need to check and read through the reports to look at as well. Also consistent increase in the sales numbers as well, and the operating cash flows. This is all like really encouraging signs, and we've got the return on equity and return on invested capital, which is steady in that area. We're looking for over 10%, but you need to check within the peers of the industry to see who's actually like got the best figures there. Debt is nothing to be concerned about either. We can see the gross margins hovering around around the mid-50s on average, and the mid-20s for the net profit margin. And we can also finally see at the bottom the total number of shares outstanding. So that's actually increasing, so it doesn't look like the company is doing buybacks here. So to spot the warning signs, we're kind of looking at the same numbers, but rather than seeing those numbers of earnings, sales, book value and free cash flow, rather than seeing those things increasing, we're starting to see them shrink. So this could give us an indication that the moat is becoming smaller. There could also be competitors who are kind of encroaching on the market share, and also they might be taking on more debt, so the debt starts to increase. These are all signs you kind of need to look for to know that maybe the moat is starting to shrink. So now let's look at a more kind of negative side of it. So here we're looking at IBM. We can see here the book value, it's kind of stayed fairly consistent, dropped a little bit there. So you can see the drops in percentages. Their earnings per share has actually been kind of definitely dropping off quite a lot in the last few years. And this is like also kind of artificially inflated by the fact that they're doing a lot of share buybacks. So this, by buying back a lot of shares, it should actually inflate the earnings per share because there's less shares out there. But in this case, it seems that they're still dropping even with that taken into account. So also, like you say, seeing a decline in sales. And also operating cash flow seems slight declines in the last 10 years, but it's not that significant. So we can see here the ROE and the ROIC is really high. Now this can sometimes be the case if the company's taking on a lot of debt, or their sales figures, their profit or earnings figures are quite inconsistent. So whereas you look at that and might think it's good, actually that needs further investigation because all the other numbers are really bad. So that's kind of, you always need to check a lot of different metrics to be sure of what's going on. And here we look at the shares outstanding. You can see they're dropping over time as they do share buybacks. So that's a good example to look at a company who's struggling a little bit more. So let's have a look at the key points. So firstly, a moat is a competitive advantage that enables a company to maintain or grow its profits consistently over time. And obviously that allows to outperform its competitors. As we've seen, there are around 5 different types of moats, but it's critical that the company has at least one. If the company doesn't have one, then we can't make an investment. Ideally also we want to see more than one because that would be an indication of a strong moat across a few different areas. We also want at least 10 years of data so we can see how the business has performed during an economic downturn or an event within their actual company or industry. The best companies will weather the storm and still outperform their competition. And we can find this information in the company's annual and quarterly reports. So the annual report, the 10K, the quarterly report, the 10Q, and also by listening to earnings calls. Good also to check out articles. You can look on Guru Focus and Seeking Alpha. I'll leave links to those websites down in the description as well. And moats are in constant flux. They're always changing, so they'll either be growing or they'll stay the same or they will start to decline. The moat won't last forever, and there's always competition and new technology that are coming along trying to change the world order. So you need to make sure that your company is capable of adapting, otherwise they will die. But the good news is, if you have a thorough and complete understanding of the business, you'll be able to see this coming a long way out. A declining moat will manifest itself in the key numbers shrinking over time, which is kind of what I showed in the example just previously. I put a lot of time into the video, so I'd really appreciate it if you leave any comments. What did you think about the video? And if you enjoyed the content, please hit like. It's always appreciated as I'm trying to build a channel. And if you're not already and you enjoy the content, then please consider subscribing as well. And you can hit the bell icon for notifications of when I release new material. So that's it for today, and I'll see you in the next video. Cheers, guys.